Okay, so I mean, the big picture force remains the same. We still have this massive infusion of money from the central banks that leads to sort of this tsunami of inflows into the market, and it continues to push markets higher overall. So that big picture remains the same and is likely to remain the same for a while. But we are getting some signs of potential trouble. And so I want to talk a little bit about that. So for example, Ned Davis has a model where basically when you get under 30% of the cyclical stocks are under their 50-day moving averages, he gets a bearish signal. And when that bearish signal develops, the market average annual return is minus 0.3%. So there's just some things in the internals that we can kind of get from what they're telling us. One thing is that we see here is when we are below 50% of the market being not above its 50 DMA, what that means is that more and more stocks are not participating on the upside, and there may be signs that more and more stocks are actually starting to go in their own little mini bear markets. And as that sort of happens in the broad market, it tends to pull the major averages at the end. So we're starting to see that. We're starting to see some problems develop internally. You want to understand that now the supply and demand balance is much more precarious, so that if we get a catalyst on the downside, or that would lead to some liquidations, or would lead to people just not demanding as much, that's going to have a bigger impact on price. That's one of the reasons why, if you go back and look at the markets since the early 60s, when you've got a lot of these breadth internals, and you can go back to the 20s on some of them, you find that about 93% of major corrections occur when you have situations like this, with weeks to months of major internal divergences building. That's when your balance of supply and demand is getting really precarious, so that if you get a negative catalyst, you're more vulnerable to the impact that has on prices. And then realize we're also in a seasonal period. August, September, that's sort of one of the weakest of the year. You usually don't get a lot of upside when you do. In the last 8 years, for example, the best year has been just a 3.47% gain in the S&P, but the worst was a minus 8.2%. And so you kind of have this dangerous period between now and sort of October, where it's seasonally dangerous. We've got some evidence that now the upside participation is definitely narrowing. We'll look at it, and there's even some more information that suggests that the downside, stocks falling on the downside, are actually increasing. All those things tell you that and so we've sort of transitioned here in the last, well, really since March, but really it's gotten really blatant in the last couple months of a two-way backdrop, where if you're trading on the short side, you're actually potentially doing better than someone who's trading on the long side, if you're doing that with our lists, for example. And it's a two-way environment. We got a narrower list of stocks rising to new highs with the indexes, with the big caps, and we have a growing list of stocks that are actually declining. So I can see this sort of our big picture internals, advanced decline, and operating companies only advanced decline line. You can see that the biggest divergence is with the net new highs minus new lows, but you can see a cumulative net volume and cumulative net points. These are all divergent for weeks to months, not 2 to 3 months in all of them, except for the NYHL. Like you would see now, you're starting to get even more of a concern, but enough that, yes, this lines up with potentially bigger corrections. So the risks are growing. It's a two-way backdrop. And then we get some things like this. So you're looking at some indicators like this, which this is a 20-day MA of down volume, which in the red, and a 20 MA of up volume in the green. And you do this on a 20, 30, and 40-day basis. It's all showing the same thing. The down volume has been bigger than the up volume. And you can see periods when that's happened before have led to corrections. And it also, what that shows you is that the participation of stocks on the downside in that two-way backdrop is actually leaning to the downside in some ways. So if you're a short-term trader or you're experienced short seller, this is an environment where you can still play some of the top industries for more upside and maybe offset your positions with shorts in some of the weaker areas, and you can actually benefit from it. But for most traders, this is a really treacherous and dangerous environment. You really want to wait until you start to see the internals improve, our supply and demand improve, and things like up volume and advances on a 30-day basis rising above their opponents. So we don't have that yet. And we can see this in some of the averages. Remember, most averages are cap weighted, and that means that the big caps really make up a huge percentage of the index. And so it doesn't really show you what all the stocks are doing. But we can see, for example, that in small caps, we've really been in a correction consolidation since March. We've had a double-digit decline, right? It's been a pretty big decline in small caps, and we're still mired in that trading range. And the same thing is true starting in May with the mid caps. And just so it's clear, mid caps and small caps make up the vast majority of stocks in the market. So really, while the averages are making these sporadic new highs, it's mostly the big caps that are doing that, and we're not getting the participation of the troops, just the generals. And for a really sustainable and substantial leg up, you want to see participation by mid caps at least, and small caps to a certain extent. They don't have to show relative strength the whole time, but not this negative relative strength trend, and not just a trading range while the rest of the market goes higher. And so I would be more cautious here. I would realize it's a two-way environment if you have ways of playing that with longs and shorts. And if not, just pull back your allocation, maybe take some profits, and wait until we get an environment where this is going to resolve itself in either of two ways. Most of the time, it is a correction, and it's a bigger correction. But sometimes, especially in the beginning of a recovery, which we're kind of in, you can get an environment where you get that for a while, and some of the market does correct sharply, but the big caps kind of hold on. You get these violent rotations, and eventually you get some sort of a catalyst that brings participation back up. And as participation comes back up, you can participate in another leg higher before you get that major correction. The other thing to realize is that the economy is sort of come off the boil in terms of maximum growth. You can see that in ISMs, a lot of different manufacturing things. And you can also see from this earnings season, the behavior of the market is very instructive. And so this has been the biggest beat quarter we've had since 2009. So a fantastic quarter in terms of the percentages of beats and in terms of the amount of the beats in both revenues and earnings. But guess what? If you just beat on earnings and not on revenue, you got punished. If you just beat on revenue and not on earnings, you got punished. Unless you beat on both revenue and earnings, you didn't even see an increase. And this increase is one of the smaller numbers that you'll see in an earnings season for beats on both. So really what you needed this season to really have a strong earnings reaction on average was a beat on earnings, on revenue, and on guidance. Otherwise, you didn't really have much of a reaction on average. And so what that tells you is that the market is priced a lot of these earnings gains into prices already. And unless they really beat clearly, the market is no longer pushing the stocks higher, even in the strongest earnings beat season we've had in decades. All right. The other thing that I want to talk about here is bonds, because bonds are really going to be a key marker for us, something to really watch closely. And I want you to understand that we're so in this environment where it's a two-way environment. We've got stocks making new lows that are increasing, and we've got a thinning number of stocks and groups participating on the upside. In that environment, that's generally often associated with a Goldilocks situation. Goldilocks situation is where it's the economy, the inflation, a whole bunch of certain things need to be not too hot and not too cold for that upward bias to continue. You get too hot or too cold, you've got downside corrections in the market. So we're in that situation, and we've got some potential things that we want to watch out for. One of them is we really haven't had a big increase in rents despite the huge pop in real estate prices, partly because of this eviction situation. Well, they're extending it somewhat, but you're starting to get more and more of that coming out. And if the evictions really start to come out more, you're going to see rise in rents. And that's going to potentially lead to another pop in inflation that the market really has kind of thought is over. So there's a potential for an inflationary pop that we have to be concerned about. And then we want to watch interest rates really carefully, because interest rates are a smarter gauge about economic strength and weakness than the market generally. They generally react better and more in sync first, and then stocks follow. So here's the TNX. I think that's the thing you really want to watch here. It's hit some downside targets, basically had a 50% retracement, a bigger correction. Remember back here, we were talking about it hitting resistance and probably going to back and fill or correct. It's had a bigger correction than we anticipated. We've had some evidence of slowdown. We've had some more coronavirus outbreaks and things that have slowed growth more than expected. But looks what has happened here. We've got a double bottom that broke out today and really broke out for all intents and purposes on Friday in the TNX, and that projects higher prices at least up to this 1.5, 1.6 area. That now we get above that, what was your economy is telling you, and the bonds are telling you the economy or inflation are getting too hot. You're going to see really more negative implications. We're already going to see some sector rotation implications from this. We'll talk about some of those. But this is basically the decline in rates is likely over, and now we're starting to head up. And the question is, are we heading up for a whole new leg up, or are we going to mire here for a long time? The Goldilocks scenario is if we remain between 1.5 or so and where we are, and we don't fall below 1.13, 1.128 really. The scenario where if there's a negative shock and a more Delta virus than is expected that has a bigger impact on the economy potentially, that's where you're going to get your bond decline, your interest rate decline below 1.128. That would tell you that's too cold. So you're looking for your Goldilocks scenario of not too hot and not too cold for TNX. It'll be an important marker for what to do and what's happening in this Goldilocks backdrop.